Good evening, good morning, good afternoon, whenever you are. This is another part of the Become the cTrader Master series, and today we are going to talk about the advanced analysis techniques and advanced charting, using, of course, the cTrader trading platform. As you can see, I am using the web version, so you can clearly see that this is my standard, let's say my standard setup here. I'm using the candlestick chart, okay, which is pretty solid and pretty popular among the traders. And of course, I have the obligatory volume indicator on the bottom. There is no indicator here. We are going to talk about advanced indicators later on. I will show you some few examples of how you can apply the advanced indicators, what do they mean, and how to use them in your analysis, how to use them in your trading. But the first thing is, this is the web trader cTrader web chart, and if you want to change this standard chart, you have to click here on these dots, and then of course you can change, for example, the time frame. If I switch to daily, this chart will looks like this. Yeah, so it's totally different because right now every rectangle is a one day. But let me just switch to the 1 hour chart. Okay, so this is the standard technique to changing the charts. Of course, you can change not only the time frame, but you can change the chart itself, the way that you see the price. For example, you can change it to tick chart. What is tick? Well, the tick is something different than the standard chart, because the tick is only this kind of a chart where the time doesn't actually matters that much. Only the trades is what matters. So one tick basically is a trade made in the up or down. Yeah, so it's a bid and ask traded on the market. As you can see right now, what I'm using is a 20 tick chart, which means that every of this well, rectangles, maybe some kind of a candles as well, is drawn after 20 transactions is made. All right. So right now, as you can see, this advanced technique, it allows me to see the purest price action chart you can imagine, because there is nothing else, just the transactions coming in and out of the market. Okay, it doesn't matter which asset you will use to display the chart, which is the tick chart. Okay, it absolutely doesn't matter. What you need to know is that the progress of your chart will be displayed after 20 ticks is made. Okay, the other quick way of remove the let's say the time factor from your chart is, of course, to use the range chart. And the range chart, as you can see, looks like this. Let me just wait a little bit for the market to display the range chart. There you go. Again, what do we have here are the rectangles, red and green, as usual. There's nothing here wrong with this. Red is up, green sorry, green is up, red is down. What you see here, of course, is range 20. Okay, 20 pips range. This is this one. So as you can see, every bar or candle is being drawn after 20 pips change of price is being made. It can take a lot of time. It can take milliseconds. It doesn't matter. The time doesn't matter here whatsoever. And of course, you got the 𝗙cie chart as well, or you can have the Renko chart. The Renko is one of the most popular one, because if you switch, for example, for the 50 pips Renko chart, that means there will be a bricks. And that means that every brick here is a 50 pip move. So you can filter out every noise, for example, coming from the tick chart. Okay, you need to use correct settings for the Renko and for the tick Nevertheless, the point is that the Renko chart is showing you clear trends, uptrend, downtrend, uptrend, downtrend. And of course, it can show you a reversal indications as well. For example, let me just uh, switch to the cursor. You have the reversal pattern here. You got the reversal pattern here. Let me just show you guys. No. Oh, there you go. Green, green, red, reversal pattern. Green, green, red, reversal pattern. Green, green, red, reversal pattern. Every brick is 50 pips. Okay, so that's not a small amount for the asset. As you can see, when it starts going down, all right, then it goes for pretty substantial for a pretty substantial level, yeah, from this swing to this swing, from the swing high to the swing low, and then again to the swing high. Very nice for the day traders and for the swing traders who want to catch a big moves on the market. Using the Renko is very good idea to do it. Of course, if you want to scalp, if you want to do something faster, then you go to 10 tick chart, and then this is the scalper's paradise. You can do whatever you want with this kind of a chart. You can trade almost every price movement. Of course, as you can see, the spread is, you need to calculate the spread as well. If you switch to the euro dollar, for example, that's completely different markets. That's completely different spread, because the Bitcoin and the euro dollar are completely different markets whatsoever, with different spreads. And now, if we switch, for example, to 20 ticks, you can maybe even see some patterns on this charts. But if we want to talk about patterns, let's switch to the standard 1 hour chart, right? Why? Because using the standard chart has its advantages as well. When you use the 1 hour chart of the euro dollar, the most traded forex pair, you can clearly see some kind of the patterns, the candlestick patterns. For example, one of this pattern is this candle. Yeah, you can call it a pin bar, or you can call it a shooting star, which is a form of a pin bar. The point is that very often traders trying to find out what's going on with the candlestick patterns, and they are using every candle and name every candle on the chart, or almost every single one, completely disregarding the fact that for the candlestick pattern to become the actual pattern indicating something on a particular time frame, then the candle alone, or the two candle pattern, must be made in a certain place. Okay, so of course, when you take a look, for example, at this pattern, you can call it a bullish engulfing, and there is nothing wrong with it, because it is a bullish engulfing pattern made after the market first made some kind of a pin bar. Then the pin bar is confirmed, so we expected the price to go lower, and it went lower next hour. Then we have like a consolidation, but no new high, local high is made above the pin bar high. Then we have a push to the downside, and then bullish engulfing pattern, and then confirmation, and then the extension. Let me just repeat what I just said, because you guys need to understand it first. This is what you get here on the euro dollar. You got this pin bar, okay? You got this big upside movement. Then you have the inside bar. You got something which is called harami. This is another pattern. And then you got the pin bar, which might indicate a potential move to the downside. If you expect, let me just move this pattern for you guys to see. If you see this on the chart, what you should expect? You should expect the market to go lower. If you want this market to confirm that the long upper shadow means that the supply entered the market. All right. So if you want to think like this, then what you should expect is move to the downside. So it's this what you just anticipate should happen should be confirmed by the market, and it is confirmed. You expected the market to go lower, and it went lower. Big red candle. Now the market might extend the movement to the downside if the supply is way stronger than the demand. So bears are way stronger than the bulls. So we might see, for example, the next candle after the confirmation might be red again. So we have the downside movement extended, right? But we can see something like this. There's nothing wrong with that, because what we need to have is the signal candle and then confirmation. Extension is optional because it depends on the situation on the market, and it depends how strong is the supply. You never know that, how strong is the supply. It turns out it's pretty strong, but there is no new low. Look at this. That's the level you want to place your horizontal line on. It's somewhere around here. Okay, this is what I mean. Maybe there's not like kind of a line, but okay, it's okay. As long as we are not trading below this level, you can see there is no close, there's no candle close below this level. The market tries to move lower, but it can't, so it goes sideways. It doesn't go up, it goes sideways, and then there you have the breakout. And this is what the bulls have been waiting for, because that signal, that movement has happened way after the confirmation candle. So this period means that something happened here. Up and down consolidation, no big moves. No one was interested to go up, so we went lower. But after such a long time, it was 1 2 3 4 5 6 7 8 9 10 14 hours later, it's already too late for the bears to go lower, which is why with this attempt to go lower, bulls came in, big down shadow, green candle, nice body. Here we got bullish engulfing pattern. Okay, we got bullish engulfing pattern, and then we got the confirmation, nice candle here, nice up candle, green candle, and now we are switching our attention to the high of this candle. You can see we've been trying to break above this level many times. This candle didn't actually made it, but if there is a breakout higher, we should follow up. And there is a breakout candle, so we got the pattern, bullish engulfing, confirmation of the expectations that the market should go up, an extension to the upside, and an extension to the upside again, the test of the support. You can see it here, and then test again, attempt to go higher, and then this happens. We got local high made at this level, but we have a very big upper shadow, very big lower shadow, small body. Market doesn't know what it wants to do. So in that situation, we go up, because this is the pattern we are currently playing. Okay, we go up, harami, bullish sandwich, we go up, bullish sandwich, we go up. So we go up, pullback, up, pullback, up, pullback. Or you can call it bullish sandwich. Yeah, green, red, green, green, red, green, green, red. Oh, this is supposed to be green, but it's not. So we have a deeper pullback, and then, of course, another movement to the upside. And now you see this. This is your last candle here. Big upper shadow, red body, small body here, means that the market is expecting some trouble to go higher because supply kicks in. What you should expect now if you see this after that kind of a rally to the upside, some sort of the down movement. So you got the confirmation, yes, another red candle, little bigger body, long upper shadow, extension. But you can see that, okay, they are coming down from these levels here, but this is not like a very dynamic movement. It's not like this, or it's not like this breakout candle. What's going on here? Oh, 4 hour, 1, 2, 3, altogether 4 hours here. We got some kind of a, let's say, different candle. Now let's switch our attention to this level, the last local high, the last local high before this one, of course, yeah, because that's the swing high. The last local high, which act as the technical support. And this is what we got. We got the technical support. The market bounces back on, but then just a new marginal high was made after so much confirmation. You can see this. You can see this candle means that the market wants to go up, but there is a nice upper shadow, green candle. So this is the up candle, and there's a confirmation of going up, but still there's a counter attack by the bears. So this range is being played right now. This tight range is being played by the bulls and the bears, and they are trying to foresee each other which one is stronger. So there shouldn't be any new high for now. And we go to the sideways, and then we break to the upside. But again, there is no big movement to the upside. Again, we got the tweezer top, this kind of a pattern here, big long shadow, the red candle, big big upper shadow, green candle. So the market again doesn't know what it wants to do. We might start to go lower. If you want to be more sure that the candle you are looking at or candlestick pattern you are looking at might be really up to something, you might find out that certain indicators are helpful for you. Right? In that situation, we are going to use the RSI. The RSI, very popular indicator. Let me just find it first. It's there you go, relative strength index. We are going to use it with the standard settings. Source is the close of the price, period is 14, and that's it. We don't need anything else. And it's drawn here on the bottom. So you can see it straight on, right, on the RSI. That's the RSI. That the extremely overbought market conditions, which are about the level of the 70, has been continuing for quite some time. And just recently, multiple bearish divergence has been made. What is the divergence? Divergence is the difference between what the market is doing. Let me just make it an arrow. Maybe, okay, this kind of an arrow, it's okay. Okay, so what market is doing is moving up, basically. There you go. Swing high, another higher high, another higher high, another higher high. Fine. What is RSI doing? Just a marginal high, and then the RSI is going lower. Take a look at this. That's what I mean from here, for example. The RSI is going lower. It's clear. Price is going up, RSI is going down, which means that one of these either indicator or price is cheating. Basically, something is wrong here because price cannot go up on a lowering momentum, which means that there is not enough buyers in order for the price to go very fast to the upside, or even slower to the upside, right? So that means that someone is cheating here. We need to call his bluff. It's either price or it's the indicator. Indicator is showing us that there is not that much interest among the bulls to continue this up move. And it's just going up marginally higher, but the momentum is gone after such a big movement, of course, from the extremely oversold levels, which is almost right at the level of 30, right? Excuse me, somewhere around here. So it's not even that much oversold. Nevertheless, this is a daily time frame chart. We can add even one more, let's say, filter for our signal to see what is going on, which would be very, very popular stochastic oscillator. And the stochastic oscillator, okay, this is of course a very slow setting. It needs to be done. So we will use 21, we will use 14 and 9. 9, sorry, 8 and 13. Sorry, this is this is the setting. One less. Thank you very much. So you can see right now that with this settings on a 1 hour time frame chart, you can see it's straight on that again. We have a cross of the fast line crossing from the upside the slow line as the prices go up, and then the RSI is going down and the stochastic is going lower as well. If you zoom out, you can see it much more clear. You see it now? All right. So this is the situation when with having only two indicators, you can confirm that what you see here might be a little bit fake, and there's a bearish divergence as well. And what you now need is actually some sort of the pattern, candlestick pattern, because you are using the candlestick, right? So what you need now is a candlestick pattern. Okay, so that's the way you don't need to let's say switch your RSI to the custom settings. You can of course make it, instead of 14 you can make 21, I don't know, 50 or 100. It only means that it will look back to calculate the RSI graph chart, basically, right? It will have to look 150 or 21 periods back. All right, so standard settings is still very well. Standard settings are still very well. You don't have to do it whatsoever. Of course, you can try if that fits to your strategy. Of course, you can try. Let me just grab this arrow and show you the volume. So I want to show you this volume, and look what's going on here. What's going on with the volume? It's pretty obvious. Again, as the price burst to the upside, it's obvious, okay, that it went on a very high volume to the upside. But then the market tried to rally again and continue this up move, but the volume has been moving lower. It's lower and lower and lower. As the price tries to go higher, the volume is either the same or lower or lower or lower or lower or the same. So again, the indication here is that market is the market is trying to go up, is trying to establish another swing high, but on the lower volume, it's again another indication that this situation is not quite possible, and sooner or later someone will call this bluff. All right, this is what I mean. Someone will say, okay, I will check. Okay, one side of the market, bears or bulls, will say, all right, you want to go up, that's not a problem, but let me just check it whether this situation is possible. And then most likely the price is basically coming off the recent swing highs, and it's coming off very, very rapidly, which is why this situation might happen, which is why this situation very often caught the traders, off guard, right? So no one expects this to happen. If you don't know how to basically do the advanced charting techniques, if you don't know how to use them, you might not be prepared for this kind of a movement. But if you just use this free, let's say, tips, this kind of this patterns, it's not the right word, that the tricks, if you know how to look at this at the chart in advanced way, then you can prepare yourself in advance, okay, for the actual market movement, for the moment when the market will do its move. Basically, sooner or later, of course, this move will be done. It can happen anytime soon. I mean, the breakout to the downside. It can happen anytime soon. It can happen during the next hour, 2 hours, 6 hours, 17 hours. If the volume keeps going down, if there is no this, if no one will disturb this pattern, lower volume during the price going up, sooner or later the market will definitely go lower. And the situation here is very often more dynamic, more aggressive. Okay, the slope of the market coming off the highs is more aggressive if another hours are passing. Yeah, so the longer the situation gets, the more vicious is the down movement here made by the market. Okay, there is plenty more of the advanced charting techniques. There's plenty more of patterns. There's plenty more of the combinations between the indicators and volumes, and different ways of playing out the divergence, for example, between the price and the indicator. We don't have that much time to talk about all, all of this during one webinar. I hope that these few tricks, these few different point of view that I just gave you during this webinar will make you a little bit better in your analysis and in your trading, and maybe give you some bigger, maybe wider, maybe different perspective of how you look at the charts, at this funny little rectangles here, in order to do your analysis or to open or close a trade on any forex market, forex pair basically, that you trade right now or maybe in the future. That's everything from me for today. Thank you very much for watching this webinar, for being here with me. I hope I will see you guys again soon. For now, take care and bye bye.